everyone. Welcome. They gave me a bottle of water today for lunch. So lunch with Don and I get water, so obviously.
We'll bring some crackers in.
Well, we're glad you're going to join us today. Thank you for being here. My name is Don Pendleton. We run a company called Protect Wealth Academy, if you haven't joined us in the past. And this is supposed to be kind of an open forum and bring your questions. And we're going to hit a couple questions right off the bat that have been hit the hotline really heavy this week. And then we're just going to open it up to you. A couple quick little announcements. Next Tuesday, we've got a webinar with Clint Coons. And Clint will be talking about statutory trusts, especially Wyoming. For those of you, especially in California, that are concerned, or Massachusetts, California has an $800 per year filing fee for every business entity, corporations, limited partnerships, LLCs. Massachusetts, $500 a year. Some of your states that have those high filing fees, there's a really good way to not necessarily get around it, but it's still legal by the California Franchise Tax Board in Massachusetts. The statutory trusts are a good way to get around that. So anyway, join us next Tuesday night, 6:30 Mountain Time. You can adjust for wherever you are. And then we've got the summit coming up in 2.5 weeks from now. That's a Monday, Tuesday, Wednesday. That will be, I think we start at 9 o'clock Mountain Time on that. And it'll run a good part of the day. They're really good classes. We hope we've got a great new speaker in Robert Sheeman coming in to talk real estate. We're excited to hear what he has to say. And new tax laws with Scott Estel. And if you didn't attend the webinar last week, that was amazing. That's available on our website. Anyway, that's all the big announcements. If you have questions, stick them into the Q comment screen, and we'll hit it. Okay. Most commonly asked question we get at this hotline is, okay, what's the best legal structure for me? And what we've done is, I really think that it's two questions. You're only asking one, but we have to break it down in what's the best legal structure. And for most people, you can set up a legal structure either 4 ways. We can set it up as a sole proprietorship, which means tax me at the highest possible rate and make me responsible for everything that happens in the business. Sometimes that makes sense when you were just starting and we're trying out a new business and seeing if there's any market viability for what we're looking to do. And sometimes that makes sense, but not most of the time. If we're serious business people, we're going to want to use one of the others. Partnerships are great when we're doing a kind of a merger. We're buying real estate and we're bringing in lots of partners. But it's not really good for running a business. For running a business, we're really either talking an LLC or a corporation. Corporations have a lot of legal formalities. They have minutes and meetings and resolutions and stock certificates, stock ledgers. Those things can bog down small businesses who probably aren't going to do all of the legal formalities anyway, and if you don't, your corporate veil is shot. So most small businesses will elect to be an LLC. Now, if you're running a business, it probably ought to be in the state where you're doing it, but how to tax the little bugger is a separate issue. Most small businesses will set up an LLC without the need for a lot of the legal formalities that corporations have. So it really, in my mind, it comes down to the two options: an LLC or corporation. Corporation is the traditional way of running a business. And once you decide on that, then we go to the other hand and we go, okay, so how do we tax it? We can tax it as a sole proprietorship, which means that there is no tax return. All taxable events flow down to the business owner. But it's really only good for one or maybe a married couple. Everything that's going to flow through that tax return, all taxable events would show up on your 1040 Schedule C. We could tax it as a partnership, That works again for real estate and investment holdings. But then we come down to a C or an S. A C is a separately taxed individual. It does have the potential for a double taxation, although you'd almost be stupid if you did that. Yeah, I've had a corporation, a C Corp, for probably 18 years, and it's never been doubly taxed on more than $300 or $400. And so if we run it right, most small businesses can run $2 or $3 million and without the double taxation issue. But C Corp, a lot more expensive, 100% medical, education expenses. There's some things that we can do. With a S corporation, the big advantages I see for an S corporation, especially when we're starting out brand new, is that if there's a loss the first year or two, that loss flows through to the owners. Let's say the first couple of years the first year you lose $20,000, and I'm the sole owner. Well, that loss goes to offset other W-2 income, other income. That's good. That may be good. It might be a red flag if it's too big. I like losses that come down and offset other income. So that's a positive. I can always convert an S to a C. It's harder to convert it back. And the S corporation helps me reduce sometimes my self-employment taxes. So which business structure do I use? Break it down between what's the business structure, corporation or an LLC most of the time, and then taxation, separate question. Once you've separated it, it's a lot easier to figure out what's your best legal structure. Okay. Kendall, do we have any questions? I haven't seen any.
So the question we got recently was, all right, so how do I protect my IRA? And that's always a good one because, okay, so some of the tax stuff goes out the window, but IRAs, are they protected?
That's a really good question. Okay, so IRAs, there's a federal law called ERISA. And what that does is that protects pension plans, 401ks, 403bs, anything that was really company funded. But it does not cover things like IRAs. It doesn't cover TSP, military plans, anything that was self-funded. I'm the sole contributor. Those won't be covered by federal ERISA laws. Now, if your plan is federally protected, you got really good protection. The case we always cite is the O.J. Simpson case, where he had a multi-million-dollar judgment against him and the best attorneys in the nation. He was taking reportedly $23,000, $25,000, $27,000 a month out of his NFL pension plan. The best attorneys in the world couldn't touch it. That's because of ERISA protection. IRAs are not protected by ERISA. They're protected by state laws, and the state laws are all over the place. We recently wrote a chapter in our new handbook, and we covered, there's an appendix in the back. Here's exactly what your state will protect. Does your state protect Roths and traditional? So we find that some states, like Montana, won't protect a Roth, but it will protect a traditional. And here are your limits. Wisconsin, I think, is fairly low, protecting, maybe it's Minnesota. Like $68,000 is all that they'll protect. Some of them it's unlimited. Some of them, like California, they give a lot of leeway for the judge to decide how much damage you did, how much money you really need for retirement. Yeah, that's a little excessive. You don't really need that much. We're going to give some of it to the judgment creditor. So we look at your state laws to protect it. And if your state laws are weak, then in this chapter on how to protect retirement accounts, we added some really good ideas about how to protect IRAs. But generally, across the board, IRAs are protected up to about $1 million from outside creditors. Then the other thing that we look at is any of the investments inside of your IRA, is there a potential for a lawsuit? Like Kendall and I have SEP IRAs, and we own real estate inside of that. could a lawsuit inside of that bubble cause everything to collapse? And the answer is yes. So sometimes we might have 2 or 3 IRAs, and it's simply paying a small administrative fee up to the custodian to separate this IRA from this IRA, and we separate it that way. So it's not an easy answer, although we really did spend a whole bunch of time on the new textbook. It was the 2020 version of the Asset Protection Handbook, and we spent a lot of time talking about how to protect retirement accounts. I hope that answers that.
Yes, Diana had a great question, so she's kind of on that already, so I love it. She says, apologize if this question already came up, but no, it's a great question, Diana. So, I have a self-directed IRA purchasing rental real estate, like with Aaron Adams.
Okay.
Very protected. So you kind of covered that a little bit.
Yeah, so Diana, hi. Oh my gosh, I miss you. I haven't talked to you for years, and I've talked to your husband a couple times, but I hope you're doing well. So yes, so in your state, I believe, Diana, are you in Massachusetts? Where did?
I don't remember,
I don't remember. You're on the East Coast. I believe your state does a really good job protecting you from outside creditors. So, we're adding. Oh, thank you. Rhode Island. There you go. Well, let's look at the textbook and see what it protects. So Rhode Island, we're going to go to the, because I don't remember all 50 states off the top of my head. Rhode Island, the exemption does not apply to a court order associated with the judgment for divorce or separate maintenance, not to court order. So child support, they can break into it. Divorce will break into it. Other than that, Rhode Island has some really good laws, and your statute is 9-26-4 if you want to look it up, Diana. So Rhode Island does a good job protecting you from outside creditors without any limitations, and they don't separate Roths and 401ks. If you guys have questions, you're welcome to call customer service and we can look up, because everybody here has a copy of the handbook, or you can order a handbook. What's the price on the handbook?
I think we're doing usually $297. Sometimes we can do $197 or some specials sometimes.
We put a lot into this.
Depends on the student,
new
yeah,
textbook.
on what they have.
So
yeah, if they have an existing one. Anyway, so another question too, Don. So on the IRAs, a lot of the protection comes from ERISA, right? And if your state does not protect it, but how likely is it? Because the theory is on asset protection for retirement accounts, how likely is a judge to crack open a retirement account?
not very likely. It has to be pretty egregious for you. For a judge to break into a retirement account. It's unlikely. And so we talk about lawsuits all the time. But Dennis Blitz, who runs, I don't know how many, almost $1 billion, and he's a custodian for he's never seen a lawsuit inside of an IRA. So Diana had several rental properties inside of her IRA. Sometimes what we'll do inside the IRA is put single member LLCs around each property or groups of properties, single member, the owner being the IRA. So what we've got is one IRA, and we've separated each asset or groups of assets with single member LLCs inside of that. Sometimes, and my preferable method is just set up another IRA. Once you've reached your tolerance level, let's say I've got a $2 million estate and my tolerance for risk is about 15% of my overall net worth in any one legal bubble. So once I've hit about $300,000 in equity, then I separate and I have another legal bubble. That could be a separate LLC, it could be a separate IRA. But Kendall, your question is good. I think that the judge would look at any other available options before he breaks into a retirement account. That would be the least thing, but certainly for child support, yep, most any state would allow that to go up. Certainly for divorce, they would allow you to go after that. But other than that, if you had an automobile accident and clearly it's an accident and you had insufficient insurance to cover the damage, I think that, but if you were fraudulent, if you're going out and hurting people, I think the judges might be willing to rip into almost any retirement account if they can get their hands on it. So good question. Thank
For
you.
sure. And so a lot of people ask questions about like Dana's question about rental real estate. We have a lot of people ask about excuse me, IRA LLCs. I've got to do an LLC for each property and then put that into an IRA. That might be overkill. I mean, you want to protect it, so it's a fine balance, but don't misunderstand. You don't have to have everything always in an LLC, not necessarily.
That's a good question. I'm not always an advocate for every single property needs its own legal bubble, whether that's an IRA or an LLC. I think the sophisticated investors that I deal with, the high net worth people, we look at their overall net worth, and we look at the risk that they have for lawsuits. If it's very, very low, we might have more equity in each legal bubble. For a brand new investor that's got one or two rental properties, almost always every property in its own LLC. But once we've acquired some net worth, then we look at, I've got 27 properties. I don't want 27 LLCs and 27 tax returns and 27 bank accounts. And then I might groups of properties. We've mentioned Aaron Adams, and he's been on our stage a lot. His tolerance for risk is about $250,000 in any one legal bubble. Then he sets up another legal bubble. For most of the high net worth people that we deal with, that's fairly common. Is around $250,000 to $300,000 in any one legal bubble. And again, we're talking net worth, we're talking equity, we're not talking market value. Equity being, here's what the property's worth. It's worth $500,000, but I've got a $300,000 mortgage on it, so my equity is $200,000. That's all we're interested in protecting. The bank's position is secure. We're only worried about protecting you. So we're looking at your equity, and we're looking at it relative to the size of your overall net worth.
And the cool part is, I love the example you give. You can have multiple IRAs too.
Yeah, you can have multiple. You can have as many IRAs as you want. You can have as many LLCs as you want. The thing that we have to be really careful of with IRAs is the checkbook IRAs come under a lot of scrutiny. And they're oversold, I believe, in my estimation, by too many marketing companies. Look, you can have control of your own IRA. You can write the checks whenever you want. You can go right to Home Depot. You can go to an auction, buy it on the spot. The problem is the self-dealing issues that most people aren't sophisticated enough to understand. Dennis Blitz has been on our stage a few times. He tells the story of a guy that had his checkbook IRA. He had a little rental property inside of that, and he's fixing it up. He's going to Home Depot, and every time he goes to Home Depot and he's fixing it up, yes, he can write a check or use the ATM card right out of the own LLC. I don't have to get anybody's permission. I don't have to ask for approval. I just simply swipe the ATM card. The problem that he had is every time he went up to the cash register, he liked Diet Coke and he liked Diamond Almonds, and so he would put that on the bill, and of course that's not allowed in a IRA. And so what he's doing is he's blowing up the entire IRA. If he gets caught in an audit, the IRS may not be real forgiving on this. And what you do is you lose all the tax advantages of the IRA. They would treat it as a distribution. Whatever's in there, they're treating that as a distribution. Therefore, you have to pay taxes and possibly penalties on whatever you just took out. You blew up your whole IRA because you didn't have somebody overlooking. I really like the reason we've suggested the IRA Club and we like iPlan Group. We like those is their fees are fairly low and they can turn real estate deals within 24 hours. They look at what you're doing and they write you a check, cut you a check within 24 hours. But now you've got somebody approving every single transaction. I like that type of overview for young investors that aren't real savvy and don't really understand the rules about how to blow up your IRA. The other thing about that, and maybe I'm taking too long to answer this, is if a judgment, you're in the middle of a lawsuit, and a judgment creditor finds out that you have a checkbook IRA, almost always now, those plaintiff's attorneys are going to subpoena all the records. And it's not so much the IRS that you're worried about, but if the plaintiff's attorney finds out that you bought diamond almonds out of your IRA, they're going to blow it up, and your whatever asset protection that you thought you had, they're going to come after that IRA, and now it becomes susceptible to the lawsuit. That's my biggest concern. The IRS might slap you on the hands and might give you, time to fix it and pay taxes and penalties on the diamond almonds. But the plaintiff's attorney will be merciless to you. And if you lose whatever protections you have and it becomes an asset that's susceptible to that judgment, that's a big deal. That's why I like the overview.
Yeah, so we're kind of going down IRAs today. So 2 questions. So finding money, I love it. You can partner with your IRA. So if you want to buy real estate like Aaron's, I love this. This is a great example. People always ask, they didn't know you can partner with your IRA to buy investments.
Okay. So what is a triple tax-free? Well, when we're talking about children's Roth IRAs, we call it a triple tax-free entity, because let's say a child, the limit now in 2021 is $12,600 of earned income that a child can make without paying any taxes. So let's say, I don't know, we're very conservative and we pay it. What will happen then is we, as the custodian or the guardian of the child, we take the first $6,000 and put it into a Roth IRA for their benefit. So they didn't pay taxes on it. That's number one. The growth inside of this Roth IRA is going to grow and grow and grow and grow and grow and grow and grow. That's tax-free, number two. And when they pull it out, because it was a Roth, assumedly they'd already paid the taxes, but there was no taxes due. When they pull money out, there's no taxes. If they want to use it for retirement, that's what it's set up for, but they could also use it for, oh my gosh, first time home buyer, they could use it for emergency medical, they could use it for tuition, books, and for education expenses. I'm not sure about housing, but for college, they could use it for, and if whatever's left over, but it's a triple tax-free environment. The contribution was tax-free, the distribution and the growth. Love Roth IRAs for kids. So, okay, question, can you partner with your IRA to purchase real estate investments? And the answer is yes. Not only can you partner with your IRA, you could partner with anyone's IRA. You partner with a spouse's IRA, or your brother, or your parents, or those might be prohibited people to deal with, but you could certainly partner. We had a situation where a grandmother was contributing to her grandchildren out of her business. They were all on her website, or I don't know, whatever they did to earn money. But she contributed to their Roth IRAs. All 7 of them got together and they bought a house. So they partnered on the deal. All 7 of these grandkids own a house, a rental house, collectively, and it's in their Roth IRAs. So certainly you can. I'm not sure whether grandma was in on the deal, but since they were minor children, she controlled it anyway, but it worked out. Anyway, yes, you can certainly partner with, let's say there's a real estate deal that's going to be $200,000. You've only got $150 in your IRA. Could I contribute $50 and the IRA contributes the $150? The answer is yes, but if you do that, we can never go back and change the distributions and go, well, I want to change the percentages. I can't do that. and now I got more money in the IRA, so I'm going to buy me out. No, can't. That would be prohibited. So once, if you ever partner with your IRA, whatever percentage of contribution is has to stay forever. So don't plan on adjusting that.
And if you were to do that, would you set up, like, let's say I came in with 200,000, you came in with 200,000 in your IRA. Would I do an LLC on my end, personal cash, and then you do an IRA, 200,000? Is that generally how it's done?
We certainly could. We could have your IRA and my IRA, and what happens, we hold the property in an LLC, and your IRA owns a 50% interest, and my IRA owns a 50% interest, or whatever the contribution was, 60-40 or 37, or whatever you contributed. But once, again, you're using IRA money, don't plan on having buyout clauses and changing the distributions. Now, 3 years from now, you add more money to the part. No, you can't do that. Once we're using IRA money, the initial contribution to that LLC has to stay the same. So okay, it says, can't make it to the summit. I desperately need help with a few things. Thanks you guys for all you do. Oh, you know what? If you can't make it to the summit, at least call our hotline and let us help you. And
sometimes I actually can't wait for the summit. So it's
can't
coming.
wait.
That's exciting.
Yeah. Good. I'm really glad. I misread that. I thought you couldn't make it to the summit. Oh my gosh, we've got such a good lineup, and we're still working on the agenda. It should be published by Monday, I think. And it's just simple adjustments. Scott Estel will be there. Clint Coons will be there. We're not sure exactly time slots, and so things are still moving that way. Mike Koval will be there, and we've also got Robert Sheeman, who is a New York Times best-selling author, I don't know how many times over. I was trying to count up all the books and put little snippets of the books on last night, and I got to about 15 books that he's written. It's like, I can't put a little snip of every one of the books he's written because there's no room on the PowerPoint slide. Amazing author, amazing presenter. He's been on stage with anybody. We're excited to have Robert coming, and so that'll be the first time he's been at a stage. So giving us a really good overview of here's what's happening in the real estate market today, and so we're excited to have that. So what are the questions we have, Kendall?
It's like, that's pretty good. That's a good lunch. Well,
enjoy your water or whatever you're doing for lunch today. We'll continue this program for a little while and see, so share it with your friends. It's a good chance for just kind of open discussion, and it's a good chance for us to hear the questions that you have. And so we hope you take advantage of it. So next Thursday, we'll see you back then. And until then, let's get ready for the summit. I'm excited to. Thank you.